Hey everybody, this is Kevin. Hope you're doing well. I have some data to show you today on value stocks. Probably the quintessential value stock is Berkshire Hathaway from Warren Buffett. That's Warren Buffett's company. And I wanted to talk to you about the value of value stocks after the last 2 years of growth stocks beating value. And so I'll come back to Berkshire Hathaway, but let me show you the data that I'm going to use to discuss this. So this data is put out by Dimensional Fund Advisors. It's the global equity markets, and this is just a snapshot in time, November 2015. I have been recommending value over growth for the last number of years, really, but number of months. I think it's getting extremely interesting. Now, that doesn't mean that value stocks as a whole will do better than growth over the next year. But if we use the last 80 years of history, over long periods of time, they do better. We want to own all the market, but we can tilt our portfolio a little bit towards value. So the way Dimensional Fund Advisors, with all their Nobel Prize winners in economics, defines the dimensions of return. That's why they're called dimensional. Market cap, the largest 500 companies would be the large cap here, makes up the majority of the market, even though there's another 5,000 to 6,000 companies in the mid and small cap. And again, small cap will beat large cap over very long periods of time, but there's more risk in owning small cap stocks. The second way they define it is value, growth versus neutral versus value. So if you take the S&P 500, it would be neutral. It has companies that are growth companies and companies that are value companies. Now, I've used I probably have used relatively bad terms to describe value in the past, and this is really my attempt to try to improve my conversation around what value means. I've talked about the companies that are maybe not the fastest growing companies, maybe not the best companies as being value. The way Dimensional Funds looks at value is basically the relative price that you're buying earnings for a really wonderful price, and they put that into the value category, and they use this aggregate P/B, and that means price to book. So what is the price that you're paying to get the amount of book value? Benjamin Graham, Warren Buffett, they look at price to book, and it is a metrics that they use as well. And as we see here in the growth in the U.S. markets, there's 547 that are considered growth companies. There's almost 2,000 that are considered value companies, and then there's 1,100, at least in Dimensional's universe, that are considered in between. They're not growth, they're not value. So when we come up here now, this is the part where it might get a little confusing, so I'll say it twice. When we come up here and we look at large, mid, and small, and then we come over and say, are these more value or growth, based off of their price to book? Or in other words, are we buying companies at a good value? And that's really what the aggregate PB is all about. So large cap have a aggregate price to book of 2.58%. The higher the ratio is, the more you're paying for basically for companies. So the value companies, and the small cap companies rather, are relatively a better value right now than the large companies. And after the last 2 years, 2014, 2015, we've seen large companies beat small companies, but over long periods of time, again, usually small will beat large. Okay? And so then when we come down here to growth, growth companies right now are trading 8.73% for the price versus the book. And once again, that is because the last number of years, growth has actually outperformed value. At the end of a bull market or deep into a bull market, it's not uncommon for growth to start doing extremely well, because as companies go up, It's crazy, but more people want to buy companies that go up. You should really buy companies that are a good value, but this is just the way markets are, and markets can stay irrational a lot longer than we can stay. We can keep our money invested. So right now, growth companies are at a 8.73%. Again, how dimensional defines the world, price to book. So you're paying a fair amount for that those 547 securities. Now, value companies, price to book is 1.23%. So remember that 1.23, a little bit less than 1.25. Okay, as far as sectors go, they divide the market into 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 sectors, and then other to pick up the rest. So those 11 sectors, where is the value? Well, utilities 1.12, telecommunications are below 2, and the more expensive places is information technology has done well, consumer discretionary, which is items that we buy when we feel good, at least that's supposed to be the idea. And then consumer staples are more defensive, and we have to buy those all the time. Procter & Gamble, we buy diapers, we buy we buy food, we buy gasoline. They're more staples. Energy and financials are actually at the lower end of value as well. We know energy prices have gone down in the companies that work with energy. And then healthcare, once again, healthcare on a valuation level is actually fairly robust right now. Healthcare companies have done well. So now let's come to non-US developed markets. And so let's see here if I can get that. There we go. This is non-US, so this is the rest of the world basically. So small cap in the rest of the world is at a 1.43% price to book. It's a little bit, I believe, a little bit higher. No, it's a little bit lower than the U.S. is. So relatively speaking, small companies in foreign countries are a better value right now. Large cap is definitely a better value right now, and mid cap. And so this is the reason why, although we all think that U.S. developed or non-U.S. developed markets, which is the rest of the world without emerging markets, we think that they're not going to do as well going forward. You know, there's trouble all around the world, and the U.S. is the cleanest dirty shirt. Well, what this shows us is that the value of these companies have been beaten down so much that going forward, they may be great investments. So here's the growth, 4.58%. Is the aggregate price to book versus the U.S., which was around 8%. And then the value companies now are below 1. Before, they in the U.S., they were 1.23, if you remember. And then across the board, the only really expensive area in foreign markets is consumer staples or consumer defensive, as well as healthcare. So I'm going to pause now and go to emerging markets. So emerging markets, after a fantastic decade, the last 3 years have been in a negative column. A couple of those years, negative 10%. So, you know, although we think emerging markets will never come back and there's problems with the US dollar and all this other jazz, the relative value of not just large companies, mid-cap companies, and small companies, these companies are trading at a price to book value that's extremely low. And then we come down here, the most eviscerated area of emerging markets has been value, are trading now 0.81 versus the US, which is 0.123. So, and you can look at these areas. You know, that thing about emerging markets, it can be all or nothing. Healthcare is at a 4, and energy is at 0.75%. So again, Warren Buffett, Benjamin Graham would say that there's value in emerging markets now. Warren Buffett probably wouldn't invest in emerging markets, however. So Dimensional considers the United Kingdom a good investable market. And so once again, you can see that the relative prices for the UK is not very good, actually, except when we go down to growth and, again, value in the UK, price to book. These 62 securities are 0.85, and most of the companies in Europe fall into both growth and value, somewhere in the middle, neither one. And so I'm going to show you just a couple more markets and then some individual countries. Canada, small companies in Canada are very fairly valued now. Canada's been beaten down as well. They have a lot of commodities, energy, other types of mining, and that's really the reason why, once again, Canada's been really kind of crushed over the last number of years. So I'm just going to show you really quickly Australia. Australia has had returns in the past very similar to the United States, and but they are very heavy into commodities. They have a very well developed banking system and others, but they're very heavy into commodities, oil, mining, steel. And so the thing that surprised me a little bit when I looked at this chart is their value companies, which are mostly what we invest in Australia. That's most of the funds that I use. Still have an aggregate price to book of 1.2, so I wouldn't say they're as cheap as other places, but still on a relative basis they're cheaper than the U.S. Value companies. So here are the developed countries and the aggregate price to book. So where is the value? Austria, which, you know, we do invest in Austria. It's not a lot of companies, only 37. It's part of the Europe, Far East, Australasia funds. Hong Kong is relatively a good value. Singapore has a fair amount of companies, relatively good value. So we can see that a lot of these markets are not really overheated. Denmark is the one I would say is overheated. As far as emerging markets go, Brazil is very well valued, but it should be with all the corruption that's going on there right now. Russia, pretty well hated right now, mostly because the 26 companies they have are oil companies. And so you can see there's not that many securities in a lot of these places. India has been doing fairly well the last few years. Indonesia has come back this year, but not doing that great. Mexico has a bit of a positive or a negative valuation because Mexico's been up just like the U.S. has been. They've been kind of tied together. And so anyway, you can take a look at the rest of these things. Now let me talk to you about Berkshire Hathaway. So this is Berkshire Hathaway. Over the last 12 months, the security is actually down 12%. Okay, 12% over the last year. And so if you're really looking at your statements and you're looking at your finances and you own Berkshire Hathaway, you could think that this is a dog. Warren Buffett must have lost his ability. And this is not the first time that Berkshire has underperformed the S&P 500. But this is something that we have to deal with as value and small company investors. If you just invest in large companies in the S&P 500, you will always track the reference, which is the S&P. If you invest in value or small or even international, there will be times when you're disappointed. But although this chart shows that Berkshire, Warren Buffett is down 12% in the last 1 year through the end of today, that's not really a reflection of how you will make money over long periods of time investing with Warren or investing in value companies. So to finalize my discussion, all I would mention once again is that investing is a long-term activity. Let me show you Berkshire over the long term. So here's Berkshire over the last 10 years. So I am no Warren Buffett, I don't claim to be, but I do claim the fact that there will be times when different investment styles will underperform the market, but over really long periods of time. His company has doubled over the last 10 years. Patience is a virtue. We do get rewarded with patience. Happy holidays to all. and Happy New Year.